Well, one of the biggest fundamentals that made Canada, strong during the recession, and where other countries were being dramatically impacted by the recession, was the fact that we have a very, very strong financial banking system, and it was a conservative banking system. The same conservativeness that investors were upset about because they weren't offering enough money at flexible terms was the very system that saved us when everybody else, kind of blew up. So, number one, we had the banking system that was really strong. Also, Canadian companies had reserves in their bank accounts, so to speak, and they were a little bit flush with cash. And in many ways, Canada didn't get hit as hard as other countries. So we didn't have the big bubble, and we didn't have the big dip. So we were kind of very steady with that. And since then, businesses, companies, and individuals have strengthened their financial positions. Banks have even gotten more conservative. So if we ever were hit with another second wave of a global recession, Canada is yet again, in the strongest, best position to absorb that. In fact, Mark Carney and Jim Flaherty recently came out and said that we have wiggle room. We have the room to absorb some recessionary impact from the United States. So again, what this all translates to is solid, safe returns for Canadians, and when the international issues grow, I wouldn't be surprised to see an increase in foreign investment into Canadian real estate, which will only further solidify our position as a safe harbor. The single most vulnerable person is the individual who is over-leveraged, decided to quit their day job to become a full-time real estate investor, and all of a sudden values and vacancies soar and values drop. That individual has nothing to fall back on, no cash reserves, no job. They can't make their mortgage payments because they got too high vacancies, and they can't flip the property, sell the property, because now the property is, in some cases, worth less than the actual mortgage. That person's in a guaranteed foreclosure bankruptcy situation. We saw this happen in Canada. We are not immune to that. So my message to individuals in today's market is don't forget the lessons we just learned 2 years ago. 2 years ago, in 2008, or 3 years ago, in 2008, we saw the height of the subprime crisis followed by the global recession. And those who were over-leveraged and, in my opinion, irresponsible got burned. And I see that tendency returning now because people are forgetting those lessons very quickly. So the way to bulletproof yourself or prevent that from happening again is just understand some very solid fundamentals. If it were me, I'd really be focusing on debt reduction, creating a little bit of buffer. Because when we talk about the wiggle room, the Bank of Canada, for example, says we've got wiggle room because they raised rates by a full interest, 1% on prime. So if they had to cut back, they can actually drop interest rates to stimulate the economy, whereas the Americans can't. They're already at rock bottom. Well, the same is true for us as individual investors. If you take advantage of these historically low rates to lower your debt and accelerate your debt reduction, two things will happen. Number one, if we do have a drop in values or an increase in vacancies, at least you'll have a lower debt position to work from and survive. If rates do go up, and you've got if you take advantage of the low interest rates to lower your mortgage debt, and rates go up, yes, you'll have higher interest rates you pay, but on a lower principal balance. So again, you'll absorb it. Plus, if you set your payments a little bit higher today in anticipation of future rate hikes, not only will you accelerate your debt reduction, but you'll adjust your personal budget to already accommodate future rate hikes so that there won't be a payment shock factor. So these are ways that simple, practical ideas on how Canadians can adjust or take advantage of today's security and low rates to adjust for future uncertainty.